Cullen, dive right into the conversation. I know you've been listening. Thanks for waiting.
Hey, Oliver. Are we having fun yet?
Wow, man. I mean, look, it's hard for me to suddenly believe this recession call after so many have been false alarms since COVID, Cullen. What do you hear? Cry wolf or the real thing?
Yeah, I mean, it's too early probably right now looking at the data, like we're not seeing this bleed into the private sector labor market, for instance. Like, I mean, if you saw the ADP report or tomorrow's jobs report's likely to be okay-ish. The worrisome thing here is that, and I think a lot of people forget this, that we already had softening conditions before all of this. The Fed was already really tight, restrictive, still trying to bring down inflation. The labor market had been softening for months. It was only back in last September, October that we had that big scare in the labor market that almost caused the emergency rate cut.
Exactly.
So, there were some dicey things already going on here. And then you get, Trump comes in, we got the big government cuts. So the Challenger Gray report this morning was a disaster. And now the tariffs are just sort of another thing that compounds all of this. So there's a lot of factors here that make the next 12 to 18 months pretty worrisome.
Okay, I hear that. Let's go. So I had two questions. One, recession is the question people have to ask. So we'll table that for a sec. Let's go to point two, which is, will the Fed cut? How do you think the ISM services from today factors into this? Because employment did dip, and that seems to be recessionary. But prices paid also came in surprisingly light. And Powell seems to think that transitory is the way to describe tariffs. We'll hear from him tomorrow, but is there still a pathway here for them to cut if they need to, possibly faster?
There's a chance they're going to be forced into it. I mean, I think that the term transitory is such a terrible way to describe all this. But when you look at, for instance, future inflation expectations, I sent you guys a chart of 1-year swaps versus 2 years. The reason the bond market is not reacting in an inflationary manner to all this is because they're looking past what will be a 1 year, likely, potentially a one-time bump in the price level. And so that's not inflation. This is not something that's going to cause the Fed to start backpedaling or anything. So if you do end up getting this pass through, which I still think is highly questionable because the consumer, I don't think is strong enough to actually bear the brunt of this. That's why the stock market is taking such a big hit on all this, is because the stock market is basically saying that shareholders are going to eat most of this cost increase. So that's, a big point here. But I think going forward, the bond market has this exactly right, that yields across the next 2, 3, 4, 5 years, they're likely to be lower because all of this is disinflationary at best over those time horizons. There's an increasing chance that all of this is deflationary, that you end up getting a relatively good-sized recession here that ends up actually causing legitimate deflation as all of the air kind of comes out of some of the speculation and excesses of the last few years. And we find out over the course of the next 6 to 12 months that, hey, maybe some more people are swimming naked here than we all expect right now.
Well, we're definitely depantsing some stocks right now pretty hard. We're getting curse words from furniture salesmen on earnings calls. So, Cullen, so I'm with you on that message then about the deflation risk being much more imminent than the inflation risk, which is, is one of the main points there. Would you then want to be in a steepener right now? Because when I look at the TNX to IRX, the 90-day rates, it's like it's saying the Fed's not going to be able to cut. Usually a massive market sell-off like this, you don't get the type of flattening really we're getting. What do you make of that?
Yeah, they can't cut in any sort of emergency manner, I don't think, in the next, unless something really starts to unfold.
Here's the question, basically. If employment bombs tomorrow, do we get curve steepening? That's kind of the question. Because the market goes cuts.
I think you're definitely going to get, bonds are going to keep rallying.
Long end bonds, yep. How fast will short go? Do you think we'll go cuts now?
key now, because here's what's going to have to happen is the Fed, and I think Powell will probably communicate this tomorrow, that he's going to look through any sort of upward tick in inflation that occurs over the course of the next 6 to 12 months, because he has to err on the side of this is potentially a one-time bump. It's not a permanent increase or a sustained rise in the price level, what we call inflation. And so I think he has to err on the more cautious side there. So the labor market is definitely going to be the indicator. I mean, these jobs report, tomorrow's a weird one because you almost have to look through tomorrow's report, because that's the crazy thing about the announcement yesterday. These are the biggest macroeconomic trends that transpire. I mean, we have a 40-year system of global trade that has been structured around free trade. And the potential that we're unwinding this, I mean, you're talking about, you called it a tectonic shift. It really is. I mean, this is a seismic shift in the way we've traded with every other country. And there's this risk that not only do other countries not blink at this, but there's a risk that companies like Nike are going to sit back and they're going to say, hey, we've invested so much time and money in places like Vietnam and these foreign countries that, hey, you know what? We're just going to sit this one out. We're going to wait until the midterm elections. We're going to wait until, who knows, the next presidential election, rather than they're not going to bring all this back. That's the craziest part about all this, is that they're not going to go from paying people in Vietnam $4 an hour to suddenly hiring. Who are they going to hire? Me and you and my mom and my.
Well, I mean, there's going to be layoffs from the government potentially. I don't know. I mean,
$25 an hour though in domestic wages.
Yeah, I mean, I get that, the mismatch for sure.
So much money to reshore all of this that it's almost ludicrous to assume that they would even consider it. They would rather wait this out and just not invest anything. And that's the most worrisome part about what could potentially happen here, is that it's not just the uncertainty, it's the potential that all these firms are just going to stop investing in everything. They're going to stop hiring people. They're going to stop investing in all the domestic services that actually keep all those foreign services functioning. So, yeah, it has the potential to cause, I mean, like a freeze of the way the free trade system has worked for the next, who knows, 12, 24 months.
Didn't we just have a massive revamp of kind of the global trade system with COVID to some extent, Cullen? Because I understand these points and I see the potential of the domino effect that you're describing, and I respect that view. But I do think that right now also there is a scale that basically is going to move all at the same time, because these are countries that still depend on us way more. We are the consumer. So it might hurt everybody, and I get that point, right? The fact that these could hurt everybody, 100% agree. But then when I look at the dollar is kind of saying that it's going to hurt us even more. And that part I have trouble with on the bounce back effect, because the whole world shut down. You used the word froze. The whole world froze during COVID, and somehow we got through that. You think this is more scary?
No, I wouldn't go there. I mean, COVID was mandated shutdown of basically the entire domestic economy. So, we're not nearly on the verge of anything close to that. But there is just a very material chance that firms like Nike and, a lot of firms just look at this and they say, all right, we're at a minimum, we're peeling back here. We're slowing down our rate of investment, our rate of hiring. And, whether you get a recession technically from that, who cares? This is an environment where corporate profits are going to decline almost certainly going forward. And margins and multiples have to come in because future expectations have to come in. And so, whether you get a COVID-like recession is unlikely, but you're at a minimum. I mean, we were already at 2.5% GDP. I mean, at a minimum, that gold adjusted GDP now is at negative 0.8%, I think, as of this morning. So, that's probably not far off the mark there. So this is not a disaster. This is not a catastrophe. It's not the sort of thing where people need to, go jump in their bunkers. But at the same time, I mean, if you don't have some dry powder to ride through the next 12 months, that could be a big problem for a lot of people.
Dry powder getting erased right now. Cullen, best way to express it. Only got about 60 seconds because we're already going through, but give me a trade, man. Give me an investment.
It's got to be anti-dollar stuff. I mean, I know this trade doesn't look nearly as good today as it did yesterday, but I mean, again, this is a seismic shift. This is not a one-day trend. I don't think that anything that's happening, in fact, the most worrisome thing that's maybe happening in the stock market is that it's all very controlled. It looks so orderly. You didn't get, I was kind of hoping this morning I'd wake up and see, 7-8%, waterfall type decline in the stock market. That's the kind of market you can look at and say, okay, we could maybe be putting in some sort of a bottom here, or like finding, some sort of bottom here. But this is,
Cullen, you don't know how good you are.
Something that is much longer lasting, and that's much more worrisome. And that to me says, hey, the potential that foreign stocks and anti-dollar trades, the gold trend, things like that, those things are not done yet.
Hey, you're perfect, Cullen, because you took us right into the next subject, which is how come the VIX didn't get to a higher high? Thank you, sir. Great to catch up with you, Cullen Roche. Appreciate that macro thought. Fun conversation as always, sir.